Right, let's look at the uh, question mock exam, June mock exam question 1, right? And again, let's read the requirement first. So we've been told using exhibit 1. So I have the exhibit 1 next to me. This was the exhibit 1. And using exhibit 1, in accordance with the IFRS accounting standards, they haven't told me what accounting standards that is relevant. I need to identify that. And I've been told to explain with calculations. So I need to explain, and also I have to do the calculations. So it is much easier, to keep things much neat. You do your calculations on the Excel spreadsheets, and then you do your explanations in the Word. So when you explain, you can bring your whatever, then you can simply copy paste, and whatever your workings you have done, you copy paste to your Word documents, right? So you just need to practice this. And then how to correct the treatment of Gamba company in the consolidated financial statements for the year ended 31st December 2017, right? For the year ended 31st December 2017. And so it is about, we still don't know what's going on with Gamba company. And then I think probably here that we have, let's read this and get this on, right? So I copied here for some reason, I copied the um, exhibit 3, which was the pre-populated spreadsheets. And I also given you, I highlighted the date on which the draft has been prepared for. This was the draft of consolidated financial positions. So when you look into the pre-populated spreadsheets, the first thing you need to make note, first we need to understand which financial statement has been given, right? Have they given us the profit and loss account, consolidated profit and loss account, or have they given us the balance sheet, right? Or have they given us the cash flow, extract of a cash flow statement? So we need to know what the pre-populated spreadsheet has been given. Once you identify which has been given, for example, in this question, we know it was the statement of financial position, balance sheet being given. So once we know, and also this is consolidated. So the next point we need to understand the date on which this was prepared, right? This is another very important bit, right? The date. We know the year ended for 31st of December 2017. And you could see the pre-populated spreadsheet was also given for 31st of December 2017, right? Now the important bit when we start reading the question requirement, right? Let's read this requirement one by one. Right, let's take the first part here. Right. So when you read the first paragraph, they're saying on 1st Jan 2017, I'll write it here, right? So they're telling me on 1st Jan 2017, what happened? Enriquez company acquired 60% of equity share capital of Gamba company, right? So this was on 1st Jan. I don't have to draw any group structure, you don't do anything like that here, right? So we know we purchased 60% here. On this date, we purchased 60%. 60% means it is more than 50, isn't it? Right? So therefore, this gonna give me control. This means that we have control, right? We have control. So who has control over whom? Enriquez, right, which was the parent here. Right? So it will be much easier for you to explain when you're going to write your explanations. Enriquez, right? Enriquez is the parent, right? And then this is the parent. And then we know that the subsidiary going to be Gamba is the subsidiary. Gamba is the sub. So we understand it now. This is what is taking place here, right? Based on this. And then we also know this date is going to be the date of control. It's going to be the date of control. This is the date of control, right? More importantly, this is the date of control, right? So you know that if you're going to calculate goodwill needs to be calculated for this date, right? Before proceeding further, so whatever calculations that I'm going to do with respect to goodwill, I don't know whether I've been asked to calculate goodwill. The question did not tell me what to calculate, right? So I can see that I was given for first Jan 2017, right? So this need to be, these are initial, when a subsidiary takes place. So we need to first know the subsidiary's initial figures. The goodwill need to be measured on that first day, 2017, right? But the more importantly, what you can figure out from there, we know the acquisition was made on this first December, Jan 2017, on the first day, right? And you could see here, we were told the current financial period was from year ended 31st of December 2017. So it has to be 1st January 2017 to 31st of December 2017. And more importantly, we bought this subsidiary on the first day, right? On the first day, right? So this subsidiary was purchased on the first day. So we're not going to have any problem thereafter if there is any issues, because we know the subsidiary going to be there for the whole year. So we don't have to worry about pro rata, anything like that, because it was bought on the first day of the current accounting period. But what is most important for you to understand, because at some point you would be asked to, in the next exhibit 3, you're going to be asked to complete this pre-populated spreadsheet, right? So using this exhibit, you would do some calculations. First calculations, all those calculations will be done for the acquisition date, 1st January 2017. For that date, you would do the measurement. That's the initial recognition. And you would do all those for the initial recognition date on 1st Jan 2017. But that information itself would not be sufficient for you to complete the pre-populated spreadsheets. Why? You are preparing pre-populated spreadsheet for this day, 31st of December 17. So after you completing this, after you completing the initial recognition, which is the goodwill and all the other workings, thereafter you need to consider what other adjustments that need to be taken for the next 12 months, right? So that you need to be considered. For example, what I'm trying to say, if there were numbers that was missed out in the consolidation statement, because this is itself a consolidated statement. Here they have some workings on the consolidated working. Something has been done already, right? So it is not every single item has been missed. Only few items been missed at this date. So the problem that we have, how that item that was missed initially, that we have recognized it now, gonna impact the financial statement throughout. For example, I'll tell you one example of a property. We were told property was not valued properly, right? They did not consider the fair, they missed the fair value. So initial recognition, you would calculate, you would bring the property fair value into it. And initially, you would add that figure onto the balance sheet as well. But then what is the impact of that figure throughout the year? Property would be depreciated, right? So now you need to think of, when you reach at this date, you need to think of what's going to happen to this figure at the 31st of December. Now you need to calculate the depreciation. So you do need to, accordingly, you need to work out the depreciation calculations. So the way that I'm going to present this part of the question, I would do 2 videos. I would do the first part for initial recognition for the 1st Jan 2017. Thereafter, I would do the next one for 31st of December 2017. So after that, we would be ready to complete the pre-populated spreadsheets, right? I hope that's okay. Right, let's move on. And so the next one, I just need to work out quickly. So here we have, right. So the 1st Jan 2017, right, 1st Jan 2017, which I have, is the Enriquez company for 60% of the equity share capital of Campa. That's done. So I know I need to calculate the goodwill, right? So I would do my working here. I write my working number 1 already. So it's much easier for me to explain. So it's going to be goodwill calculation, right? Goodwill in Gamba. Right? Goodwill in Gamba at on what day, as at or on what date we got goodwill calculations must be for 1st January. So goodwill must be for 1st January 2017. That's what we calculate the goodwill for, right? 1st January 2017 is what we calculate the goodwill for, right? So we know this is the working we are starting it, and then, for your purposes, in your writing purposes, you will remember what accounting standards that will you bring on to explain. You would quote IFRS 3 business combinations. You can quote IFRS 10 consolidated financial statements. You can quote IFRS 13, which is fair value measurement. All these standards could be quoted when you're going to explain. These are there for your reference purposes, so you don't miss when you're trying to explain. So the first part of it, we just need to know. So the first part of it that we just need to know how we gonna deal with the goodwill calculations, right? Let's work on. So come on, why? Don't go. Right. So now I need to work out first fair value of the consideration. I'm buying in it, right? I'm buying, so it has to be fair value of the consideration transferred, right? So let's see the first one, consideration fair value, because of that is what I was told. Fair value of consideration transferred, right? Fair value of the consideration transferred. How much was it? They said on 1st Jan 2017, 60% equity shares were purchased. Consideration transferred was cash, 50 million, right? Cash was 50 million. So fair value consideration transferred, I would write here. The first one is cash. What date was this for? Every single thing would be for this particular date, you know? So I would have 1st Jan 2017. So cash fair value for that day is the same. So I will write 2 columns. I may need it. One, suppose if I need anything to do, and then here the second column I will write the cash has been paid, right? I'll put this in. Shall I put first column? I'll put 50 million was given, right? That's no problem, right? And then the next one is what? And also Enrique's company must also make a further payment of 35 million on 31st December 2018. Now here you need to carefully consider, right? So further payment means and the date is important. What was current date? 1st Jan 2017. What was this date? 31st December 2018. But this is at the end of 2 years, right? So end of 2 years, these dates would help you a lot even in the pre-populated spreadsheet, because you're not gonna pay at the end of 2018, 2017. You're gonna pay at the end of 2018, right? But then, when you're gonna do the pre-populated spreadsheets later for this date here, right? So for this date here, when you're going to prepare the pre-populated spreadsheet, 2018 is due at 12 months time, in 12 months time. So that would help you to determine whether this is going to be a current consideration, deferred consideration liability, or a non-current deferred consideration liability. So the classification, this date would be helpful at a later point, right? Not now. I'll cover that in detail in my next video. So that's the first one, is on the cash. We recorded it. And then they're saying there is a 35 million we're going to pay later. So we can clearly say this is not contingent. Why? There was no additional conditions there. So this is a deferred consideration. So now I have here, it's a deferred consideration, right? Deferred consideration. So what I need to do when I have a deferred considerations, I need to know the present value of my deferred consideration. Now this is what is needed here, right? I need to find the present value of my deferred consideration. This is what is much easier when you work out with Excel, so you can move on to the other side, right? So I need to find my present value of the deferred consideration. Right, I know it was 35 million. 35 million was the amount in US dollars. This is the future value, and we were told this is 2018. So from 2017, so this is 2017, right? 2018, 2017 December is 1 year. 2018 December is 2 years. So this figure is 2 years away at the moment. So I need to find its present value. So I need to discount it by the discount rate which was given to us. I think I forgot to copy that again. I think it was given to us somewhere here. Where was it called? Is here. Right. So this was given to us in the exam by the examiner, right? And where it was given at the bottom of the page, at the end, we were told this, right? They were told that 5% is the discount rate. So we use 5% to discount, right? So we can use 5% to discount. So 1.05, 5% means 1.05. 5 divided by 100, 0.05. 1 plus 0.05, 1.05 to the power 2. I'm doing the same way like you learned in finance, rather than trying to find the discount factor. I hope you know how to deal with if they have given a discount factor instead of giving you the uh, discount rate. If the if what was given to us is a discount factor, we would simply multiply it to find the present value by the discount factor. So come on. Right. So here I have no issues. I can simply need to find the difference between this will be my present value. And if I found that my present value, if I find my present value, and that present value of the, I need to move a little bit further down to the other side, right? So that I need percentage, right? So that present value of this amount is equal to, what is the present value of this amount is equal to? So that amount is equal to 35 divided by 1.05 to the power 2, right? To the power 2. So that you could see the amount is equal to 31.1 decimal place. I'll keep the amount, right? It's 31.17, right? 31.17. I'll make note of this, right? That is deferred considerations, right? And then what has the other informations which they have given me with respect to the deferred consideration, right? With the deferred consideration. And they said there was no accounting entries have been recognized in relations to this deferred consideration. So you need to know what is the double entry. Then they said they haven't recorded. Even at the initial recognition date, this was not recorded. No double entry being done. I'll write it here straight away. Then you know what is the double entry for this deferred consideration, right? So we know that's what we need to go and do at a later point, right? So the double entry for the deferred consideration, right? The double entry for this deferred consideration here. Deferred consideration liability. Why it is a liability? Because we haven't paid. We're going to pay later. So it has to be a liability. Deferred consideration liability. So what is a double entry? A liability always easiest to start from thinking of the liability. Liability always a credit balance. So you would have a deferred tax liability, right? You have a deferred tax liability account. Deferred consideration, right? Deferred consideration liability would be credited by how much? So I got the your solution as well here. Deferred credited by how much? 31.7. At the same time, where the debit gonna be go? Anything related to the subsidiary. Note this carefully, right? Anything related to the subsidiary at the date of acquisition would go to the goodwill account. No, nothing would go to the profit and loss account, right? Anything related or the date of the acquisition related to the subsidiary, one of the entries would be to the goodwill account. So debit gonna go to the goodwill account, right? Debit would go to the goodwill account. Debit would be goodwill account. Now, what you're expected to do later, then goodwill account going to be 31.7. Now, think of this now. Now, this is where it's going to impact you. You're going to, when you do the pre-populated spreadsheet. So, when you do the pre-populated spreadsheet, because of this, Debiting goodwill means you're increasing the goodwill. Goodwill is an asset. Debiting goodwill means you're increasing the goodwill. So in your pre-populated spreadsheets, you need to have goodwill, right? A plus amount. Right? So you would increase this under goodwill, right? You would increase this under goodwill, the pre-populated spreadsheets, right? And here, this would be a liability would be increased. In a pre-populated spreadsheets, you would increase you would have a column for deferred consideration. So you have a column for the deferred consideration liability. You have a column for the deferred consideration liability, and then you have an increase. This is the pre-populated spreadsheets, right? What you're going to do, right? So this is what you would do in a pre-populated spreadsheets at a later point, right? When you start activity 3, then you know the exhibit, the requirement 3, you know this is what you need to do. You need to go to goodwill, you add 3.7, you do the deferred tax, you do the add 3.7, but this would be for what date? This will be for 1st Jan 2017. But when you reach 31st of December, which is a reporting date, so at the reporting date, we need to rethink what other adjustments we need to. That's what we're going to do on the next video, right? So then we know whether the goodwill has impaired, whether we have to bring any impairment, or whether the deferred consideration liability, with respect to deferred consideration liability, what we have done here, right? What we have done here, the time value factor, we have discounted this, right? So because why? To reflect how much it is worth today. So every year, when 1 year completed, we need to reverse that time factor, right? So as at 31st of December 2018, now this is for 31st of, when you do for 31st December 2018, you should know that this deferred consideration need to be reversed, right? The unwinding discount of 1 year need to be reversed now. You need to know what is the double entry for that unwinding discount. I think we have done past papers on this too, or similar, right? I'm trying to prepare you for the activity 3 at the same time. I mean the pre-populated spreadsheet, right? So that is done. Moving on for the next, now I'm on this paragraph next. So now they're talking about the carrying amount of the net assets at the individual, right? So we know if you're going to work out, right, if you're going to do this working, and there was nothing else were discussed, and we were told the money now we know the total money that we paid, right? The total money that we make it smaller, right? The total money that we paid, right? The total money that we paid. This, the total of this, right? This is the total of this that we have paid. The total money that we paid was this much, right? And that was how much here. I'll put the total there, right? And so this is the total money as a parent that we paid, right? How much is the total money that we paid? The total money that we paid is equal to 81.74, right? This is what we paid, a 1 decimal place, 81.74. And to buy what percentage? We bought only, according to the question, only 60% that we purchased, right? We bought this only to get 60%. This 60% is what we paid, 81.7. So that means it clearly shows that there is missing 40% there. Who would have bought that 40%? That is NCI. So we need more information when you do with NCI. Why? NCI could be measured using full goodwill method, or NCI would be measured using partial goodwill method. We don't know what was yet, right? So let's read to the next slide. And so the next slide, they're talking about the net asset of Gamba's net assets they're talking about, right? So I can also deal with the net assets straight away and then come back to the goodwill, right? So, and then I can just quickly show you the goodwill amount in the next paragraph here, right, of the NCI. And so if you read this line here, and what they have said, it is the group policy to measure the non-controlling interest at acquisition at its proportionate share of the fair value of the subsidiaries identified net assets. So the examiner is telling me the way to measure the NCI. Is telling me, please measure the NCI at what? Proportionate share using partial goodwill method. NCI as a percentage. What is the NCI's percentage? 40%. and 40% of what? Subsidiaries net asset. But that net asset must be fair value net asset, not the carrying amount. Subsidiaries fair value net asset, right? So that's why that I know I can't complete this unless I have the subsidiaries net assets, right? So that's what this is being given. They have given me, right, in this sentence to start with, they have given me the carrying amount of the Gamba's net assets in the individual financial statements. 80. So it would be wrong if I take 80 million here. Why? That is not the fair value. That is just the carrying amount. We don't calculate goodwill based on the carrying amount, right? We need the fair value of the amount. So for that purpose, I know I need to find, if you add these two together, that will represent the 100% of that will represent the 100% of what we have purchased from subsidiary shares, right? Who contributed? We contributed. This was us. We contributed twice, right? Two different types of transactions on the same day. So one was immediate, one was a deferred, and then NCI also contributed. We don't know how much the NCI contributed. Once you find out what was the NCI's amount, we would be able to find out this amount, what was paid for the 100%. We still don't know yet, right? Therefore, because we are considering the 100%, we also need to know what is the total fair value of the NCI net asset of the subsidiary. So this is the fair value of subsidiaries, right, which is Gamba's net asset, right? For what date I needed? For 1st January 2017, right? So that was the date, that was the date I do this calculation, 1st Jan 2017, everything for this particular date. So I need to know but then they have not given me the fair value. I need the fair value. They only given me the carrying amount. So I start from the carrying amount. So what they given me, net asset carrying amount. Net asset carrying amount. What was the figure? 80 million to start from. They given me only US dollars 80 million, right? And then they said, included in the net asset acquisition was one figure, which was a factory, right? Which was a carrying amount of 10 million. That means within this 80 million, there is a factory worth of 10 million. They had it only at its carrying amount. We know when we prepared goodwill working, the every asset liabilities that we get from the subsidiary must be recorded at its fair value. So they have given us only at its carrying amount. So we know we can't, so we need to bring that to the fair value. So what was the change? But the fair value was 40. So already 10 has been accounted in. So we just only need to add the figure that was missed, which was the 30, which was missing, a fair value of 40, right? So the missing figure, we need to bring this to 40. So the missing the figure is 30 to bring this 10 to 40. So this is the fair value adjustment. So this is the factory fair value adjustments, right? Factory fair value adjustment. Right. So how do I work this out? Fair value was 40, right? Fair value was 40. And then what was recorded is 10 million, right? What was recorded is 10 million. Right. So what was recorded is 10 million. So 30 million is the fair value adjustments, right? Right. 30 million is now, make note of this too. Now see this figure, right? They missed it. They didn't record it. So now this, when you do the pre-populated spreadsheet, this figure has not been taken into account. So this need to be recorded in the pre-populated spreadsheet, right? This need to be recorded, right? So we are increasing the factory, right? So in the pre-populated spreadsheet, right? So in the pre-populated spreadsheet, you have to increase the PPE. If it goes a factory, it should be under PPE. Increase it by 30, and then remember this transaction was done at the date of the acquisition. So the next entry has to be the good, right? So you would increase that, and also you would increase the goodwill by 30. That is the adjustment that you're going to do for this working for the pre-popular special. Now you would get a question of then what is the double entry for this? So you would have a question. So what would be the double entry for this? The double entry, right? And so you have the increase. So this is what you have in it, right? And so pre-popular spreadsheets, you have 30, you would increase on the, and then the goodwill would increase, right? Goodwill would increase by 30. And because, no, sorry, the goodwill would decrease by 30 because of this, right? Why goodwill has to be decreased by 30? Um, you know, you know how the goodwill works, so from here net assets, right? If you're going to increase if you're going to increase the net if you're going to increase the net asset, right? If you're going to increase the net asset, you're going to from this figure you're going to deduct the net asset. If you're going to make the net assets bigger, so your goodwill would shrink, right? So the double entry for this would be, the property is increasing, right? That means we have factory, right? Factory, the PPI, you would debit, that would increase of 30. So the next entry has to be the goodwill account. So goodwill would be decreased, right? Goodwill account would decrease, credit 30. That's a double entry for this. I hope it's clear. Any transactions, entries that is taking place at the acquisition date, the corresponding entry has to be good, right? See, earlier corresponding entry was good, corresponding entry is good. So this is what you would do at a later point when you deal with pre-populated spreadsheets. I'm just writing it now, so you know what is expected. You would find it much easier to understand pre-populated spreadsheet. But remember, these pre-populated adjustments for what date? Only for 1st Jan 2017. Then when you reach the reporting date, you need to see what else need to be done with respect to this. First, we need to bring the initial recognition. Then we need to think of the subsequent reported recognitions, right? So that is being done. And then we move on the rest with respect to the next one. Now they're saying, see, this is given about the depreciation, 15 years. Now, why this is being given? Because we know once we recognize on this date and the 12 months have gone, so this was not depreciated, right? This extra 30 million was not depreciation, not depreciation. Had this 10 million was depreciated, yes, they have done that everything properly, but this 30 million was not depreciated. So 1 year is finished. So we need to depreciate for that one particular year. That's what we need to do. And also then we have to consider the impact that we need to share between the NCI and then the parent, right? So these are depreciation charges need to be shared between the NCI and the parent. Suppose if you have a goodwill impairment, in this case, it will not be shared it will not be charged against the NCI because NCI using partial goodwill method. Suppose if you have an exchange gain or an exchange loss, translate in the goodwill, again, it will not be taken to the NCI. Why? Because we are using partial goodwill method. Those are the two that will not be taken. All the other would be charged to the NCI, right? I hope that's clear. The next line here, what we have, the tax base of the building, right? In the carrying amount in the individual financial statements, right? So now they're talking about a tax base, right? So it is about deferred tax. They're talking about the deferred taxation, right? So in order to understand this, you need to know how the deferred tax work, which is IAS 12, deferred tax. We have done this similar work. I'm using this works, right? I'm using these slides so that you have understand how it clearly works, right? So your answer would be only up to this, right? I'm giving you good explanations in detail so that you understand clearly. So the next is on the deferred tax. I also do a deferred tax for you to explain, right? So they're saying there is a deferred tax explanations, right? There is a deferred tax calculations for what purposes? This is for what? This was the factory fair value. Factory differs, let's say that factory, right? And within brackets, I put the fair value adjustments, right? We could have simply done the workings only for the fair value, so that I will explain it properly. And you know how deferred taxation works. And you know what is deferred taxation? IAS 12. You could have referred this when you explain IAS 12. in your answers, right? So that's IAS 12. So how deferred tax works? What is a deferred tax means? Deferred tax means it is a difference in the carrying amount, right? Carrying amount. So when I say carrying amount in the consolidation statement, right? Carrying amount in the because we are preparing consolidation statement, right? Carrying amount on the consolidations, right? So and then the tax base, right? What was the tax base and the difference between these two? That would be the whether we would know whether it is a taxable temporary difference or whether it is a deductible temporary difference. We would know, right? That's the difference. So now they are saying this 30 million would have triggered a deferred tax implications. Why? Because subsidiary recording it only at the carrying amount. So the tax base would also record them only at the carrying amount, right? So what is the carrying amount for the tax base then? Tax base only would record this at the carrying amount, which was original figure was 10 million. That was the original figure. And they said, see here, they said 10 million was what the tax base was. And they would only have to record 10 million. But how much figure the consolidation was recorded? We have recorded it at the fair value. When I say carrying amount means carrying amount for the consolidation is actually the fair value, isn't it? Carrying amount is at the fair value. That is what the carrying amount. Subsidiaries asset. We record at the fair value. So there is a difference. Now, how do you know whether you're going to get deferred tax liability or deferred tax asset? Because it's an asset that we have, right? We were sent a tax bill thinking that we only have 10 million worth of a factory, right? So suppose if you sell that asset factory in near future, and how much money that we would receive, and based on that, they would tax base would consider only the 10 million would be the cash that we would get in future, and so that's taken on board, and then the tax would be computed having only thinking that only in future we only would get 10 million proceeds by using this by selling this factory or using this factory in our business. We would get only 10 million worth of profits. That's how the tax base would have calculated, and I was sent a tax bill on that. But I am recording 40 million on my books, but I'm paying tax only for 10 million worth of an asset. So I have put 30 million more. So this would mislead the stakeholders. Why? Stakeholders look at my financial statements, they would think, oh, look, he doesn't have much tax liability and he has more asset. So this is why IAS 12 would prevent us doing this. It would advise us, if you are considering more 40 million, but then please remember, for that extra 30 million, you're going to pay tax in future. So that is what is known as this extra 30 million, which is 40 minus 10, which is known as the temporary difference, right? This is known as temporary difference. Now you need to understand this clearly here too, right? In this case, this is temporary difference, yes, but what temporary difference? This is known as in future we're going to pay tax, so it is taxable temporary difference, right? I hope that's clear. So it's taxable temporary difference. All I now need to do, I need to apply with the corporation tax, you know? So they told me the corporation tax in this case, right? They have given me the corporation tax as 20% in this example, and if you just apply the 20% of the corporation tax, you would get deferred tax. Now this is what you have to be very careful, right? So when you apply deferred tax, try to calculate this way. The amount we're gonna get is not the charge. The amount what you're gonna get, this is your deferred tax liability. This is your deferred tax liability. Right? That means this is what your carried forward balance should be. They're saying please go and equal your carried forward balance to what figure? To 6, right? So they want me to go and equal it to 6. Now the question you would ask yourself, do you have any deferred tax charges on your opening balances? We don't have. This is the first time we are recognizing deferred tax. So the opening balance is 0, closing balance is 6. If you want to balance it, that means a charge has to go 6 million charge need to come into play. 6 million charge need to come into play. But remember, any deferred tax liability that arises, if you remember the IAS 12, arises during the acquisition, need to taken into goodwill account, not to the profit and loss account. So this 6 million deferred tax related to the subsidiaries factory, double entry would be credit. We're gonna, of course, we need to increase the deferred tax liability. Credit will be the deferred tax liability for factory, and then the debit entry would be the goodwill, right? So I'll write the double entry here, right? Let me write the double entry here for you too. Double entry for this deferred tax gonna be, deferred tax is a liability, so credit gonna be where we would have credited the deferred tax, credited the deferred tax liability account, right? And this is for the factory, right? And then the how much we would credit 6. So the debit gonna be what? Debit gonna be when? Debit gonna be goodwill account, right? Debit gonna be goodwill account, right? How much was the goodwill account? 6. Now remember, it is important to note the date. This entry would be done for 1st Jan 2017. That means the acquisition date, right? So because it is acquisition date, nothing gonna go to the profit and loss account. All the entries would be done through goodwill, because it was a step the acquisition date, so everything would be done through the goodwill account, right? So deferred is only, I can spell deferred, right? Come, right? So that's done, right? So we know now later when you, for this date, initially on the pre-populated spreadsheet, you would go and increase your goodwill by 6, and also you would go and increase your deferred tax liability by 6. But thereafter, 31st December, we have to consider this again, right? So that is done. And so that's been done. And now I know now I need to bring the deferred tax liability here, right? So there is a deferred tax liability on the factory, right? On factory, deferred tax liability on factory, right? And the fair value adjustment was 6. It's a liability, so it has to be negative, so a liability is -6. I put them in red now, so I know these two entries has not gone into the pre-populated spreadsheet. So this would also come to pre-populated spreadsheets, which I have given you here, right? That's also done. But remember, all these entries which I have done, these are for what date? These are for 1st Jan. Initial recognitions only, not for the reporting date. I need to, once this is done, I need to rework the reporting date at the end. So I've done this now. So based on all the information is given, I've completed it. And then I have this next line here. It says it's group policy to measure the non-controlling interest at proportion. We have done that. And now they are saying additional information. The additional informations are what? They have already done some goodwill, right? They have done some goodwill working. Now we can think, let's finish our goodwill calculations. Then we can look at what they have done. So now we need to calculate the goodwill. So if you calculate the goodwill, all I needed is my net assets. This is the total figure I was given. And this was the total figure I was given. And this, I can write this as the net assets, fair value. This is the net asset at fair value, right? At what date? On 1st Jan 2017. What was the amount I have the net asset at the fair value? The amount is equal to 104. Now this 104 is what will be deducted from here, right? Now think, can I complete the goodwill? No. Why? I haven't done the NCI working still. I couldn't do the NCI. Why? I did not have the net asset of the subsidiary. Now only I found the net asset, which was 104. Now I'm ready to find the NCI, which was the partial goodwill method on this 104 million, right? On this 104 million is what this is calculated. So I just need to simply calculate this. So it's 104 and times, which is 40%, right? Which is, sorry, 104 times 40%, right? So this is 41.6. right? Now, if I add these two, I come back to the double increase. If I add these two, that is the total money we paid. The total that we paid 123.3 for by 100% of the subsidy. I paid 81.7 and then this NCI paid 41.6. What did we buy? We bought the subsidiary net asset, which was worth only 104 million. Then the question here is, why did I pay more? Why did I pay more? The reason why I have paid more, because of the maybe possible reputation that they have. This is known as the premium goodwill and the positive goodwill. So the positive goodwill here is going to be 123.3 minus, right, minus 104, right, minus 104, and that's done here 19.3. So this 19.3 here is known as what? This is the goodwill, right, in Gamba, right, on what date? At the acquisition date. So 1st Jan 2017, right? Now, what is important here? You see this now, right? This was 41.6. All these are for 1st Jan 2017. So in my next step, next video, what I would do, I would start to bring, update what I have now into the pre-populated spreadsheets, because then I have completed the initial recognition on the pre-populated spreadsheets. Once it is done, then only I would think the next working that need to be done to complete the year end 31st December. If you split that way, it is much easier to understand this, right? So what I have done so far, here, right? This working so far, this is what for 1st Jan 2017. Remember I said to you, so far what I have done only for this date. So I can go and whatever the numbers that was not accounted in the spreadsheet, I can go and update. But what I'm doing it, I'm only doing it for 1st Jan 2017. So for the same numbers, I need to consider what going to be the impact. What other entries I need to put as for the 31st of December 2017. That also I need to work out, right? I would cover that in the next video. So in my next video, mainly I would be starting to update pre-populated spreadsheet. I would give you a hint how to decide how many columns that you need to organize, and also how to first process the update the pre-populated spreadsheets, right? And I would cover that in the next video, right? Thank you.